The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova 401k Associates webinar, Introduction to the Secure Act. This will be presented today by Jason Worms, a team leader and consultant out of our Houston office, and Steve Best, the Vice President of Nova. If you have any questions throughout the presentation, please type them in the questions box, and Jason and Steve will answer them at the end of the presentation. I also sent out just a couple minutes ago, or just about a minute ago, a PDF copy of the slides that will be used today in case you would like to refer back to this information in the future. If for any reason you did not receive the PDF copy, please send me an email to arogers@nova401k.com and I will get that provided to you. A recorded version of today's webinar will also be made available on our website within 1 week. If you'd like a link to that recording when it is available, you can also send me an email and I will send you the link as soon as it is ready to go. Jason, we are ready.
Thank you, Andrea, and thank you everybody for taking time out of your busy schedule to join us for our webinar today. Like Andrea said, we're going to be talking about the Secure Act and what it means for your retirement plan. So let's get started. Before we get into the meat of the webinar, just our standard disclaimer. This information is general in nature. It should not constitute tax or legal advice. If you do have questions of that nature, we definitely encourage you to consult with an attorney or a accountant for advice of that nature. There are a lot of changes in the Secure Act, more than we can realistically cover in a single 50-minute webinar. So we are going to have multiple webinars that go into a deeper dive in the Secure Act in the future, and we will definitely make you aware of those as they come up. In the meantime, we know that there are a lot of questions about the Secure Act out there. Please feel free to send questions to your account manager directly, or Nova has set up an email box specifically to deal with Secure Act questions. You can send them to secureact@nova401k.com. And you'll see that email address again at the end. But that is set up specifically to deal with questions regarding this law change. So today we're going to cover some of the big topics of the Secure Act. We're going to start with just a summary, but then we're going to dig into the RMDs. We're going to talk about birth and adoption distribution options. We're going to talk a little bit about tax credits, and we're going to talk about long-term part-time employees. And then we have a couple of other provisions that have a bit further out effective date that we can get to if time permits. So the Secure Act is not its own standalone bill. It is part of the Further Consolidated Appropriations Act. This is the omnibus budget bill that was passed and signed into law on December 20th, 2019. The Setting Every Community Up for Retirement Enhancement piece was an amendment to this spending bill and is in that larger bill in its entirety. Each of the provisions in the Secure Act portion of this bill have their own effective date. Some of them are in effect now, others don't become effective until next year, and still others don't become effective till even further down the road. And to help illustrate this, we put together a handy-dandy chart. So the main ones that we're going to be talking about today is the middle panel. So the 72 required minimum distribution age, stretch beneficiary payments, birth adoption withdrawals, those types of things. These are the topics essentially that we're going to be going into in a little bit more detail today because they are effective right now. Future changes are the items that we'll get to as time permits at the end of the webinar. And then some of the immediate and retroactive changes, they are a little bit more nuanced and only apply to a relatively small percentage of plans that are out there. So we're not going to spend a lot of time talking about those. So one of the big questions that people have is, okay, the Secure Act passed. What do I need to do to my plan? the good news is that there is no immediate need to amend your plan document. The Secure Act gives us a couple of years actually to amend our plan documents to conform with the language in the new law. And we are anxiously awaiting a lot of regulatory guidance from the IRS and in some cases the Department of Labor to tell us how we need to word those plan amendments. So the short answer is there is nothing that needs to be done to our plans immediately to conform with the Secure Act provisions. So like I said, a couple of years, 2022 is the current amendment deadline. 12/31 of that year is the deadline if your plan is on a calendar year basis. Typically, when these big law changes go into effect, it is not unusual for the IRS to extend that amendment deadline as well. It really depends on how fast they can get regulatory guidance language out, how quickly the plan document providers out there can update their systems with that language and get the things out to our plan sponsors. The plan amendments are going to apply to 403B plans, to 457B plans, and qualified plans, which include your 401ks. Before the plan is amended, your plan must comply operationally with the law. So what that means is that to the extent that the provisions in the Secure Act are optional for your plan, you as the plan sponsor will need to coordinate with NOVA to track which operational elections you are making. So there will likely be some kind of a checklist. If you are one of the plan sponsors whose participants had to use the hardship certification form because you had participants that were claiming disaster relief of one form or another, it'll be a similar type of thing to that. Again, most of the changes in the Secure Act are optional. They are not mandatory, but there will be some of them. And again, there'll be a separate interim amendment needed for some plan sponsors as well. So one of the biggest changes as a result of the Secure Act deals with required minimum distributions. It is effective 1/1/2020, so it is in place now and it's generating a lot of questions. So we wanted to make sure that we dug into to these issues today. There are three main changes to required minimum distributions. The first is the age has changed from 70.5 to 72. We're going to talk a little bit about that here in just a moment. Also, the rules around stretch IRAs have changed, so we're going to talk about that too. And then there's also the possibility of new mortality tables that impact how much participants take when they calculate their required minimum distributions. So what changed for the required minimum distributions is that pretty much everywhere in the law that it used to say 70.5, it now says 72. Okay, it applies to 403B plans, it applies to 457B plans, it applies to qualified plans, and it applies to IRAs. Now, like I said, this portion of the law is effective 1/1/2020, which means that if you turned 70.5 prior to December 31st, 2019, you apply all of the old rules. Okay, so only if you turned 70.5 after December 31st, 2019 does this new rule apply to you. Okay. So here's an example. If you are the unfortunate soul who was born on June 30th, 1949, you turn 70.5 in 2019, which means that your first required minimum distribution has to be taken by April 1st of 2020. You are 70.5 before the end of 2019, so the old rules apply to you. If you are considerably more lucky by being born just a day later, you didn't turn 70.5 until 2020, which means that you don't turn 72 until 2021, and you don't have to take your first required minimum distribution until April 1st of 2022. Okay. So the key dates to remember when your participants come and ask you these questions is your birth date on or after July 1st, 1949? If it is, you are in the clear, you get to use the new rules. If it is earlier than that, you are not in the clear and you are using the old rules. Okay. All right, so let's go through just a couple of typical questions that we're already getting from our plan sponsors and plan participants and financial advisors out there. You got an individual who turns age 70.5 in 2019. The person has not taken his RMD from his IRA yet, preferring to wait and take it by April 1st, 2020. And then he'll take his second RMD by December 31st, 2020. Can this person delay his RMD until age 72 now because of the law change? And the answer is no. The key here is in the very first sentence. An individual turns age 70.5 in 2019. That means that the old rules apply to that person. So he would have to take his first RMD by April 1st of 2020 and a second one by December 31st. He does not get the advantage of the new law. Can an active non-owner participant still defer his RMDs from his 401k plan until he terminates employment? And the answer to that is yes. So the only thing that changed in the law is the age, right? It only changed from 70.5 to 72. None of the other required minimum distribution rules changed. So a participant who is still employed and is not a greater than 5% owner, they can still choose to not take their required minimum distributions as long as they are continuing to work. Okay. So that rule did not change. It is the same as it has always been. So similarly, does an actively employed greater than 5% owner need to take her RMD from the company? And the answer is yes. Again, that rule did not change. If you are a greater than 5% owner in the company, you cannot delay your required minimum distribution. You still have to take it according to the rules that have been in effect forever. Is this an optional change or a required change for qualified plans? We don't know for sure. We're waiting for guidance from the IRS that will make it certain, but all of the early readings and many of our colleagues in the industry are pretty sure that it is going to be a required change. So that would mean an update to your plan documents and one of those amendments that I was talking about just a few minutes ago. So we are waiting for guidance to make absolutely certain, but we are probably 95% sure that it is going to be a required change. Okay, moving out of the age change provision and starting to talk about stretch IRAs. So what used to be the case was that when you had a participant who passed away and they did not have a spouse as their primary beneficiary, the beneficiaries could stretch out the payments over their own lifetime. So if you had a person who selected their grandchild as their primary beneficiary, when that participant died, the grandkid could take distributions out of that account over the grandkid's life expectancy, which meant that they could take distributions for possibly 30, 40 years out of the plan. And that had the effect of keeping more of that participant's account tax sheltered, right? So it's not being taxed, it's not generating income for the U.S. government. The participant is allowed, or the beneficiary is allowed to continue to accumulate wealth in that through investment earnings. So these were all good things from the beneficiary standpoint and from an estate planning standpoint in many instances. The Secure Act eliminated these so-called stretch IRAs. So what it means is that grandchild now, when grandpa passes and leaves them their 401k account, the non-spouse beneficiary has to take the distributions spread out over a no longer than 10-year period. So what that does is it makes more of the account balance taxable, which the U.S. government likes very much, and helps get that balance cleared out of the plan. Now, if you're a spouse of a deceased participant and you're the beneficiary, you can still spread out the distributions over your own life expectancy. But this was done. This change was done as kind of a revenue raising option for the government because it allowed them to have other tax incentives applied in the Secure Act that they thought were going to be more useful. So the third piece, talking about required minimum distributions, is talking about updated mortality tables. And actually, this is a common misconception. The Secure Act itself did not update the life expectancy tables for RMDs, but in 2019, the IRS did issue proposed regulations to update those tables. The IRS is under no time constraint to issue final regulations for these new mortality tables, so it could be a couple of years before we have them and before your plan would have to adopt them. So really nothing to worry about on this front at this time, but because they happened pretty close to each other, people assume that the mortality table is updated with the Secure Act, and that is not the case. Okay. This is another provision that is effective in 2020 that is a giant change for how things operate. The Congress developed an entirely new type of in-service withdrawal option for 401k plans. And it is a in-service distribution that participants can take after the birth or adoption of a child. So sometimes this is known as a baby distribution because it's a lot easier to say baby than birth adoption distribution. But here we go. So here's how this works. First off, it is important to remember that just like any other in-service distribution provisions in your plan, this is optional. You do not have to allow this type of distribution in your plan. Similarly, if you do allow this distribution option in your plan, you have choices to make as far as like what money types can be taken for the distribution and some other things. So there's a lot. If you want to do this, you do have a lot of options. So if you do allow these, the distribution would have to be taken within a 1-year period after the birth or finalized adoption of a child for your participant. For each birth or each adoption, the plan participant can take up to $5,000. This does require a plan amendment because, like I said, it's an optional provision, and so you'd have to make the elections about all the information. The employee, when they request this distribution, will need to include the name, age, and social security number of the child on their tax return when they file for the year, and they will probably be required to submit some kind of verification documents similar to hardship withdrawal requirements. But there hasn't been any guidance provided on that yet, so we don't know exactly what's going to be required to process these. So these distributions apply to 401A plans, 401K plans, 403B, governmental 457B plans, and IRAs. These distributions get very unique tax treatment. They are exempt from the 10% premature distribution penalty, which usually applies to distributions that are paid to participants that are under the age of 59 and a half. Also, most distributions that are taken as in-service withdrawals from a plan are subject to 20% mandatory tax withholding. These distributions are not. And presumably that is the case, although the guidance hasn't said this for sure, because these distributions won't necessarily be eligible for rollover. So we're waiting for more guidance from the IRS and the Department of Labor on these things, and there will be much more to come as these things get fleshed out. Another kicker for these distribution options is that participants can repay the distributions that they take back to the plan. So these aren't like participant loans where they have to make the repayment, but they do have the option to repay them. If they choose to repay, the repayment goes into the plan as a rollover contribution. There is a lot of gray area right now as far as what the actual mechanics are for this. There's questions about a participant making a payment to the plan with after-tax dollars, but it goes into the plan on a pre-tax basis. There is a question about how long a participant has to make a repayment to the plan with this. There's questions about how tax treatment goes if they make repayments to the plan. So there is just a lot of uncertainty about how this is going to go, and so NOVA at this point has made the decision that for plan sponsors that want to have this distribution type added to their plan, our default is going to be to exclude the repayment option. Now, again, if more guidance comes out, or if a plan sponsor really wants to allow this for their participants and has this set up with their record keeper and a procedure in place internally, then we will absolutely work with them to make that happen. But as a default, we're going to set up plans to not allow repayments of these distribution types. Again, this distribution type is available effective 1/1/2020. So in theory, on January 2nd, you could have had a participant coming to you and ask you about these birth adoption distributions. I hope none of you did. And if you did have participants come and ask you those questions, I hope that you asked your account manager. Again, you need to amend your plan. The amendment, the form language to amend plans to allow for these distributions typically comes from the IRS itself, and is not currently available. So anyone who's doing amendments at this early stage is essentially making up what they think the language from the IRS is going to say. Because of that, we don't think that this distribution option will be effectively available until probably April. And we make that guesstimate just based on our experience with the IRS and how long it typically takes them to issue guidance on things like this. The other wild card in this is your record keepers, right? So the John Hancocks, the Voyas, the Empowers of the world, they need to figure out how to accommodate this distribution type and set up their systems to be able to do that. That is not as simple as flicking a switch, because a distribution option like this hasn't existed before now. So it's going to take some time to adopt the technology necessary to make these happen. So a couple of questions on these birth and adoption distributions. And again, these questions are based on NOVA's current reading of the law, understanding that there is a lot of guidance still to come from the regulatory bodies. But a question: can both the father and the mother request a distribution from each of their plans? Absolutely, they can. So if you and your spouse both work for the same company, you can both submit individual distribution requests to take up to $5,000 out to help pay for the birth or adoption of a child. And then the distribution amount is a per child amount. So for the next question, in the case of twins, for example, what are the maximum birth adoption distributions available? So if you're a parent, you can take up to $5,000 out for each child. So if you have twins, you could take $10,000. If you have triplets, you could take up to $15,000. Still no word from the IRS if you could do that all with a single distribution form, or if it would require 3 separate distribution forms in the case of triplets. But the distribution is per child. So that's could be a nice perk for somebody who has a giant unexpected expense. Can grandparents take advantage of the baby distribution? Generally, not really, unless they adopt their grandchild, and then they hit that adoption clause, and then they can take the distribution for that. But they cannot take a distribution because their son or daughter has a new baby. Okay. Couple of more questions here. In a remarriage situation, can you take advantage of this baby distribution if you adopt your spouse's child? And our current reading of the language says no, that is not the case. So that's one little caveat to this. Is this an optional in-service distribution? Yes, this change is optional. So again, your plan does not have to offer this distribution type. but it is available for you if you want it. And then what documentation is required? This question is asking, like, what would a participant need to provide you to prove that they have had the birth of a child or that they've adopted a child and that they've done it in the last year? There's been no guidance from the IRS about this yet either. So I'm sure there's going to be more of that coming. When that guidance does come, you can bet that NOVA will be on top of it and will be providing additional webinars and other information to our plan sponsors so that you can be armed and ready to take on any questions that you get from your plan participants. So now I'm going to turn it over to my colleague Steve, who's going to take you through some of the other changes in the Act.
Well, good afternoon, everyone. Hopefully you can see my screen now.
You're good.
But okay, great. The Secure Act made some changes to some of the safe harbor plan rules. And again, a safe harbor plan is a plan that exempts employers from some of the annual required non-discrimination testing that NOVA performs. There's about 4 or 5 different non-discrimination tests that we have to run on any 401k plan. And if a plan qualifies as a safe harbor plan by providing a very specific either matching formula or profit sharing formula, then they can be exempted from at least a couple of these tests that we have to perform. One of them is the average deferral percentage test, which creates the need for refunds if you have low participation in your plan from your non-highly compensated employees. So the Act eliminated some of the notice requirements, but only for one of the 2 safe harbors. Again, there's 2 types. You've got a matching safe harbor with a specific formula that needs to be adhered to. And then you also have what's called a non-elective formula, which is a profit sharing style of formula, meaning that a percent of pay is given to each eligible individual, regardless of whether they actually contribute to the plan, whereas a match, the contribution is only given to people who actually contribute themselves. So these plans prior to the Secure Act were subject to notice requirements. By December 1st of the year preceding the safe harbor year, all employers are required, they're going to be safe harbor for the upcoming year, were required to give notice to their participants that the plan was safe harbor and what the formula was, and there's a bunch of other requirements that are in those notices. If this is news to you and you haven't sent out any safe harbor notices yet, please contact your NOVA account manager immediately, because they were required for safe harbor plans were effective for 1/1/2020. Now, the notice requirement for the non-elective variety of safe harbor is being eliminated. You still need the notice for the matching variety, and that includes any qualified automatic contribution arrangements. That's what QACA stands for. You still have to have also, if you have a non-elective safe harbor plan, and you're also funding an additional match on top of that, which is pretty uncommon, but it does happen, you still have to send the notice out on those types of plans. Again, this notice is always required before the plan year begins. So effective for plan years after 12/31/19, which is the year we're in, these notice requirements are now in effect. You would need a retroactive amendment. Again, most of these changes in the Secure Act are optional changes. So to the extent that you want to take advantage of them, a plan amendment will be required. Jason mentioned earlier that we're going to have to track what elections all of you are making based on what you want, what kind of plan type you have. And so we will be sending, as you request changes, we'll be sending these checklists out. They're not actually ready yet since these rules just came out, but an amendment will be required. And, continuing to give the notices out as has been done in the past is okay too. That's always okay. But for the safe harbor non-elective, they've been eliminated. So some examples, you can have a mid-year safe harbor non-elective adoption, meaning I want to change mid-year to be a safe harbor plan, specifically the non-elective variety of the plan. Prior to this change in the Secure Act, that was impossible. You could not become a safe harbor plan in the middle of a plan year. That was just prohibited. Now, if you want to change in the year, for example, in the year we're in right now, you can amend the plan up to 30 days before the end of the current plan year to be a safe harbor plan for that year. Again, never permitted before in the past. The required contribution for a safe harbor non-elective plan is that 3% of pay is given retroactively to 1/1/2020 to anyone who's eligible to contribute. Even if they're not contributing at all, it's not a match. If you're eligible, you're going to have to put in 3% of pay to qualify under this type of plan. In addition, one of the other requirements to any safe harbor plan is that the employer contribution that goes in is 100% vested immediately. So if someone leaves your company, they get to take it all with them the moment they leave. So here's an example, in the middle of this year, NOVA prepares some mid-year testing for your plan. That's a service we offer in the middle of a year to see how your average deferral percentage test is actually looking for the year. Is it going to fail? Are there going to be refunds? That sort of thing. And in this example, if the mid-year test fails, then it looks like we're going to have a lot of refunds projected for highly compensated employees for this year, which of course would not occur until the first quarter of the following year. But a lot of money is going to be returned to the Highleys. You as an employer could make an election at that point to become a safe harbor non-elective plan in the middle of the year. Again, all of the eligible employees would have to get a 3% of compensation contribution, but that would eliminate the need for refunds. So that is going to be another option that adds a lot of flexibility for employers who might be failing this test. Again, it's not necessarily cheap, depending on how large your group is and how much they make, but at least it'll be an option. Also, there's the ability to adopt a safe harbor non-elective plan retroactively. So you can switch the safe harbor non-elective for the preceding plan year after the plan year closes. Again, never allowed before. The amendment is going to be needed before the end of the following year. And if the one caveat here is that if you're going to adopt or become a safe harbor plan retroactive to the prior year, they're going to up the contribution on you. You're going to have to put in 4% of pay retroactive to 1/1 of the prior year. Again, it's a key concept. I know a lot of employers kind of get confused that, well, why do I have to contribute based on the entire year's worth of compensation when I just adopted the plan in the middle of the year? It's just a requirement from the IRS. This also applies to the QACA safe harbor non-elective. Again, this is a variety of safe harbor non-elective that is also includes automatic enrollment. All right, so an example here, so we're in 2021 next year, and NOVA, like we're doing in this first quarter for 2020 for the 19 year, NOVA is going to be preparing your annual testing in the first quarter of next year, and we happen to go ahead and perform the test, and it looks like it's failing, and normally we'd have to refund money by March 15th to highly compensated employees. You can actually now amend your plan to a 4% safe harbor non-elective for the prior year, for 2020, after that year is actually ended, and eliminate your need for refunds. Again, the amendment does need to be signed. It would need to be signed before the end of 2021. Some other changes, again, qualified automatic contribution arrangements or automatic enrollment plans, where if a participant does not make an affirmative election to contribute to the plan, you can put language in your plan that indicates that anyone that doesn't get back to you and say either I want 0 in the plan or 10%, whatever their election might be, the language in the plan says that they'll be put into the plan at a certain rate. Let's say it's 3%. In addition, there are rules that can automatically increase that initial percentage up to a certain cap. The previous cap was 10%. So on 1/1 of each year after participants initially enrolled, if you had auto escalation language in your document, you could increase the percentage from 3% to 4% at the beginning of every year until you get to this cap. They have increased the cap now to 15%. The formula that's required for the automatic enrollment plan has not changed. It's just the cap. The plan, again, would need to be amended. This is an optional change. And if you don't want to change your cap at all and leave it at 10%, you can do that as well. But it does, again, just give more flexibility to employers to get people enrolled and get them contributing at higher and higher rates, which is the government's goal in general. So lower in-service distribution ages. Some plans, again, this is not really for 401k plans, which I know most of you have at this point, but certain pension plans like a defined benefit plan or a 457 plan historically have had required in-service distribution ages that are much higher than 401k plans. And now the Bipartisan American Minors Act has increased decreased the in-service distribution ages to make life a little easier for these types of plans. So if you have a defined benefit plan or a money purchase plan, the previous age was 62. So if you were still employed, you could not take a distribution at age 59.5 like a 401k plan is able to do. It used to be 62. Now that's been changed to 59.5. Similarly, for 457s, the age was even higher. So a governmental plan, and we do actually have some, the in-service distribution age was age 70.5. I mean, if you were still employed, you could not take your money out of the plan under any circumstances before that age, and now they've reduced it to 59.5 for governmental plans. These age changes, once again, are optional, not mandatory, and require plan amendment. Currently, there's one little caveat. I think the IRS will adjust this, but there's no remedial amendment period, meaning that if you wanted to adopt this change this year, for example, you would need an amendment this year. There's no adopting the amendment in 3 or 4 years retroactive to this year, like some of these other changes are going to be permitted to do. I think this is just an oversight from the IRS, and they will probably make an adjustment to conform this retroactive amendment, so so that you can actually adopt it. Worry about the amendment a few years from now and put a retroactive effective date in. Employer tax credits. Most of you on the call are, you have pre-existing plans, and this really doesn't apply to you, but we may have some investment advisors on that might be interested in this subject. But for startup plans, there has always been a tax credit, and the amount has been increased, but the government, to help encourage the adoption of 401k plans and other qualified plans, was offering tax credits to employers that had a brand new plan startup. So the change now on the increase for this credit amount is effective for 1/1/20. It does apply to brand new plan sponsors, so you're not going to get it if you have a pre-existing plan. It's only eligible for small plans. Again, they're trying to get more small plan employers to offer retirement plans to their participants and employees. So you need 100 or fewer eligible participants. This deduction can be applied for 3 plan years. I said deduction, it's actually a credit. And it's taken on Form 8881. But the previous, the current increase is you can take up to 50% of your eligible expenses up to a new maximum. And that maximum is the greater of $500 per year for 3 years, or the lesser of $250 per eligible non-highly compensated employee, or $5,000. I think most plans, whether they're startups or not, have more than $500 in expenses, so you can essentially eliminate A. The new increase is the lesser of $250 times the number of eligible non-highly compensated employees, or $5,000. All right. Eligible expenses include the startup costs of the plan, the administrative costs, the annual administrative costs for 3 years. Also, a new change is they've offered a credit for EACAs, which are eligible automatic contribution arrangements. Again, another form of automatic enrollment. But in this case, you don't have to be a brand new plan. If you decide that you want to offer automatic enrollment in your plan, they're trying to encourage automatic enrollment in 401k plans at the federal level. So they're offering a $500 credit per year for 3 years, which applies not only to new plans, but existing plans that add an eligible automatic contribution arrangement to their plan. It's just a feature checkbox, and then you can start automatically enrolling people. Again, this is a form of kind of forcing people into the plan. Again, if they don't make an affirmative election, whether 0 or some other percent, you automatically put them in the plan at a certain percentage. That's what automatic enrollment is. And also, this particular credit is not limited to the operating or setup expenses, but it is capped at $500 per year. So a quick little chart. The old credit was just a flat $500 for the first 3 years, not to exceed 50% of the startup and operating costs. Now it's this $250 times the number of non-highly compensated eligibles you have, up to $5,000 per year. And the credit cannot exceed 50% of your startup costs. So to get a $5,000 credit, you'd have to have at least $10,000 in total costs per year to get the full $5,000 under this rule. But it is an increase. How that works is displayed under this example. If you have a company that sponsors a 401k plan and wants to add this example is about an employer. So this only applies to brand new plans. If you have a pre-existing plan in the prior 3 years, you're not going to get the credit. So an example of that is a company that has a 401k plan already and maybe wants to add a defined benefit cash balance plan this year for its employees. You're not going to get the credit. I mean, it's a new plan, but since you have a pre-existing plan in the prior 3 years, you don't get the credit in this situation. This is the example I thought I was talking about a minute ago, but a new plan, for example, this is how the expense or the credit amount would be computed, but a new plan with 2 owners and 10 eligible non-highly compensated employees. The plan's annual costs, the actual annual costs are the $1,600 base fee plus $24 per participant. So the total annual cost is $1,840. Since you're capped at not being able to take more than a 50% credit, you take half that amount, your credit in this situation would be $920. If the plan added eligible automatic enrollment provision, then you could essentially double that. So see here. Again, these tax credits how they're applied really depend on your entity type. So we definitely recommend you consult with your tax advisor and accountant to determine how to apply it and what benefit it's really going to be to you if you're a brand new plan. So I'll speed through this because I know it doesn't apply to most of you. Long-term part-time employee changes. So the prior law was that employers could exclude part-time employees as a classification, but number one, the exclusion needed to be in your legal plan document and still does. But the caveat was, if a part-time employee worked 1,000 hours in a plan year, you still have to offer them the plan. Now that rule has not changed. So if you're excluding part-timers and any of them work over 1,000 hours, you still have to include them. There's no choice there. The law has been expanded though. Now employers must allow certain part-time employees to contribute, at least contribute on a deferral basis. All right, and so the new rule is still the old one, right? Which if they work 1,000 hours, you definitely have to offer them the plan. But in addition to that, if there are 3 consecutive years with at least 500 hours worked and they're part-time, you have to allow them to defer. Now, this is effective for plan years beginning after 12/31/2020. So you're really not even starting to count, these 500-hour years or computation periods until 1/1/2020 next year. And since they have to work that number of hours for 3 years, your earliest entry date you'd be looking at for part-timers would be 1/1/2024. Okay. So long-term part-time employees who are eligible solely because of the 3 consecutive year rule, however, can be excluded from a lot of the other employer contributions. So say if you're making safe harbor contributions or discretionary contributions, top-heavy minimums, your ADP, ACP testing that we have to perform for you, you do get to exclude them from that. So this is really that the part you simply cannot exclude the part-time, long-term part-time employees from being able to contribute themselves. They're trying to do away with that, but they don't want to make it too difficult for the employers, and so you can actually exclude them for other purposes of the plan. There are also some special vesting rules that go along with these changes. So, what if an employer, since you don't actually have to give them an employer contribution, these 500-hour per year employees, what if you optionally want to do that, right? So a company decides, I want to do that. How does the vesting work? So the long-term part-time employees will receive 1 year of vesting credit for any plan year in which they work 500 hours if you're going to make an employer contribution. Like typically, everybody else in your plan has to work 1,000 hours. So if I were you, I would not decide to be contributing employer contributions to these employees, because then, you're actually going to be giving them accelerated vesting that you wouldn't even give your normal full-time employee. That just doesn't seem fair, right? And again, if the long-term or part-time employee ever works more than 1,000 hours or 1,000 or more hours in any plan year, you're supposed to allow them to participate just like any other employee, and you can't exclude them from the employer contributions anymore. Okay, so that's something to keep an eye on. They also would keep their vesting credits that were earned prior to working 500 hours or 1,000 hours. So maybe you had to include them because they were under the 500-hour rule, and all of a sudden they work 1,000 hours. They get to keep that vesting credit. They don't revert back to having to qualify for the 1,000 hours for the prior years. Okay, all the future years would be computed under the 1,000-hour rule. So again, vesting, just to update everybody, is like if you in a calendar year, most plan years are calendar years. In a calendar year, if an employee works 1,000 hours, they get 1 year of vesting credit. That's how the vesting works. There's a lot of questions about how to administer these new rules. Luckily, they're off into the future. Also, the investment and record keeper provider, the investment providers are going to need time to update their systems. These are big changes in terms of how you would compute who's eligible and when. So stay tuned. We expect a lot more guidance from the IRS as we go along. A few quick slides at the end here. The IRS also has increased the penalties for not filing 5500s and your 8955s, which is a return that reports terminated individuals who are in your plan to the Social Security Administration. These are significant penalty increases. They're tenfold penalty increases. So again, this emphasizes the need to make sure that those 5500s and these forms are being filed in a timely fashion. Again, we at NOVA, we send out reminders because we do prepare these forms for you, but at the end of the day, the 5500 has to be signed and then submitted by you as a plan sponsor. And missing some of these deadlines, now the penalty is quite significant, not that it wasn't before. Also, the IRS has issued some disaster relief for major disasters. Again, these would be like some of the forest fires in California, hurricanes, things of that nature. The IRS and the DOL usually maintain lists of what qualifies, but they will now, again, this needs an amendment to be done, but Loans, up to $100,000 loan limit. Most loans are restricted to $50,000 max. Extended repayment periods. Again, normally most loans have to be repaid within 5 years. Up to $100,000 in a disaster distribution. Again, this assumes the participant has this much in their account, but you could take a disaster distribution up to $100,000 and not have to pay the 10% early withdrawal penalty. There's also the opportunity to repay the withdrawal within 3 years, and could pay the tax or spread the tax on the distribution that you. So the tax is still going to apply, but they'll allow you to spread it over 3 years. Also, the recontribution of hardship distributions that were taken to purchase a home in a disaster area. All of this, again, requires a plan amendment. They're optional. I don't know if I'd necessarily recommend it. It does add complication to the plan, but it's going to be available if we want to optionally elect this. So I think at this point we want to leave some time for questions at the end of the presentation. Andrea, I don't know if we have a lot at this point.
Yes, we've received a few questions. Again, if you did not receive the PDF that was sent out before the start of the webinar, you can go ahead and send me an email. We will make this recording available on our website. It does take us about 1 to 2 days to get that on the website, but if you send me your email, I'm more than happy to send you the link as soon as we have that available. And first question we received: would it be best to recommend the employee adjust their regular contribution instead if they want to repay the balance?
It sounds like it's the birth or adoption question that's pertaining to. I mean, that's definitely easier from an administration standpoint than doing the repayment, but the participant might have a windfall of some sort, right, where they have a lump sum of cash that they want to pay back all at once, and it's not feasible for them to up their deferral rate that high. So while that is a solution, it's not going to be a solution for every situation.
All right, next question. Do employees only become eligible for the birth distribution after the baby is born or during pregnancy?
The way that it is written, that from our perspective, is that it is after the baby is born. So pregnancy is not a distributable event. The birth of a child is.
Okay, next question. Will employees that had babies in 2019 be eligible for the birth distribution?
The way that it's written, yes, because participants have up to a year after the birth or adoption to request this distribution. So yes. Now again, we're constrained by the ability of record keepers to accommodate these distributions in their systems and for guidance to be provided by the IRS or Department of Labor.
All right, next question. Do we know yet if this will be retroactive year? Example, someone born in December 2019. Okay, I think you just covered that. Similar question. If employee had child in 2019, would they be eligible for the withdrawal in 2020?
And again, I mean, it's something to keep in mind. I don't know at this point that we would be recommending that clients put these distributions into their plan, especially with some of the questions that are still out there, and how certainly, like Jason mentioned, repayment is not going to be an option under our default procedures, just because there's too much up in the air about how that would work from a taxation basis. So it sounds nice to put this in your plan, but again, taking distributions for the birth of a child, unless it's absolutely necessary, is probably counterproductive to a retirement plan. So it's going to be optional at this point, probably not recommended on our part.
All right, next question. We are a nonprofit. So the tax credit, a credit from payroll taxes or from income taxes?
Yeah, so nonprofits are an interesting question where I definitely talk to your accountant about it. Um, the expenses of a plan can be deducted. So they've always been able to. So let's say you had like $10,000 worth of expenses, you can deduct that before your taxable income for your entity is determined. Nonprofits, I don't think actually are have to pay any federal income tax. So if you're not subject to taxation, it probably makes more. Again, I'm not an accountant, but it probably makes more sense to take the deduction for the expenses to zero out any tax liability. But again, I'm not a tax expert. So for an entity that is subject to taxation, has taxable income, the credit is applied after you figure out what your taxable income is so that you get a further reduction. But that's not exactly how it might work with a nonprofit. So I would definitely talk to your accountant about how that's going to, how that would be taken on what line item to see if it's even worth it for a nonprofit.
All right, next question. Just to clarify, we now have to offer our 401k plan to part-time employees, and does this depend on hours worked?
Yes. So again, if any of you are not sure if you're excluding part-timers even now, number one, it has to be in your document, and if you're not sure if your document includes language to exclude part-timers, I would definitely contact your Nova account manager immediately so they can read your document and let you know. But even if the language is in there now, again, if a part-timer works 1,000 hours, you cannot exclude them anymore. That's the old rule, and it still applies. The new rule is that starting in 2021, you have to have this exclusion in your plan. I'm excluding part-timers. You will no longer be able to exclude part-timers who work 500 hours in 3 consecutive years after 2021. So you start counting you look at that excluded group and start counting the hours, and then you can't exclude them anymore. So the IRS has never liked the exclusion for part-timers because they don't like service-based exclusions in the plan document, meaning, I'm excluding them just because I call them part-time. The maximum exclusion waiting period in a 401k plan has always been 1 year of service, which is, the first year that you work 1,000 hours in. And they view the exclusion for part-timers as a circumvention of that rule, right? Like I just call them part-timers and they can work 1,000 hours and I'll just keep them out. They don't like that. So they're already moving to reduce it even further, this ability to exclude part-timers. So as a matter of good business practice in your plan, if your plan already indicates you exclude part-timers and you want to avoid this complication that I just went through, I would think about not excluding them anymore altogether. Just treat them like any other normal employee with the waiting periods that you have in your plan. And you don't have to worry about any of those hours and how many years am I counting, and I mean that just sounds extremely complicated and hard to administer from our perspective.
All right, next question. Do advisor fees, if billed directly to the plan sponsor, count as administrative costs eligible for the tax credit?
I think routine operating expenses would include that as well. Yes. Again, if you're paying a bill to your investment advisor who's providing services to the plan, I don't see why that wouldn't qualify.
Regarding RMD plan amendment, will Nova advise when you have all the information for amendments of our plan, or is this something the plan sponsor should direct?
Nova will definitely be in touch as we get that guidance from the IRS and we get those plan amendments ready for plan sponsors. We don't know yet if if the amendment will be something that we can adopt on a plan document sponsor level, or if it's something that individual plan sponsors will have to sign off on. So as we get that information, we will definitely be sharing it out.
All right, and that's all the questions we've received currently.
All right, well, appreciate everybody being on the webinar. And if you have any further questions, by all means, send it to this email that we have up right now, and we'll be happy to get to those questions that you might have. Again, we appreciate you being on the webinar. We know that this is not your primary function, or the 401k plan is not your primary function at your company, so we appreciate you spending the time.
Hey, Steve. Jason?
Yep, thank you, everybody. Appreciate your time. Have a great Wednesday.
Jason. All right, if you did submit a question that was not answered today, we will go ahead and answer that. I will forward your email along, your question along, and someone will get back with you today. Again, if you did not receive the PDF of the slides today, go ahead and send me an email. Or if you'd like a link to the recording that will be made available on our website within the next 1 to 2 days, go ahead and send me an email. Thank you, everyone, for attending. Have a great day.